different assets are treated differently when they pass to the next generation. So, for many families and many people, just the two largest assets you have are your home and your retirement accounts. So, like an IRA or a 401k, and then your house. So, what's important to understand is those two assets, like a 401k and a house, are handled very differently from a tax perspective. So, when someone inherits real estate, like your home, it's going to receive what's called a step up in basis or a step up in value. So, that means the date that you die, that date, they're going to value the house at that date and then give that to whoever you have it going to. And that's their new basis. What do I mean by basis and why does this even matter? Let's do an example. So my grandmother is 99. She will be 100 in March. So she bought her house, I don't know, 70 years ago or so. And fast forward 70 years later, I bet that house is worth a lot more than $10,000. Just for fun, let's just say it's worth $500,000. Well, if she passes away and gives that to her children and they inherit that, they're going to get a step up in basis. So the assets that they get is going to be, they're going to say, here you go, here's your house. It's $500,000. Now, from here, if you make money on this house and it grows past that, you can pay, your capital gains from that $500,000 to whatever you sell it for. Imagine if you didn't get a step up in value and you bought it for she bought it for $10,000, and maybe you're already on the account as a joint owner. There's ways, talk with your estate planning attorney and financial planner to make sure you have these things titled correctly, because otherwise the basis would be $10,000, and now you're selling it for $700,000 80 years later. You got to pay capital gains on all that. So this is a huge difference. So because of that, if you want to help your heirs avoid large capital gains, think about how they are inheriting the house and make sure your titles are right on all those things. And the retirement accounts are different. So when someone inherits an IRA or 401k from like a parent or something like that, the money in those accounts has never been taxed yet. So the person who inherits them is going to need to pay income taxes when they withdraw those accounts. So the rules can be, depending on your situation, the types of beneficiaries, the types of accounts, like whether it's a spousal beneficiary or not, there's a lot. Work with your financial planner or your estate planning attorney. They're the ones that'll help you think through the tax side in these decisions, because they're the ones that see the whole picture. So that's why we position ourselves as personal CFOs. We're the ones that see the whole picture. So we're making sure all those things are there and nothing slips through the cracks. So make sure you have a professional on your side to help you with that.